September 1929, New York City. At 9:30 a.m., the opening bell rang on the floor of the New York Stock Exchange. Within weeks, fortunes that had taken lifetimes to build were erased. Bankers jumped from windows. Brokerage houses shut their doors. Ordinary families who had borrowed against their homes to buy stocks discovered that paper wealth can evaporate faster than morning fog. But here is the detail most people never hear. While the Dow Jones Industrial Average fell nearly 89% from its peak, certain assets didn't just hold value. They multiplied, quietly, systematically, almost invisibly. The same pattern repeated in 2008. It repeated in Argentina in 2001, in Russia in 1998, in Lebanon in 2019, in Venezuela throughout the 2010s. In every major economic contraction of the past century, most wealth was destroyed, but specific categories of assets surged, not because they were lucky, not because their owners were geniuses, but because economic collapse follows structural laws. Most people think crashes are random disasters. They are not. They are repricing events, sudden, violent revaluations of what the system thought was valuable versus what is actually scarce. And when that revaluation begins, capital does not disappear. It migrates. Understanding where it migrates is the difference between financial ruin and strategic positioning. Before we identify the 5 assets that historically double during crashes, you need to understand what actually happens during a collapse. Because without that framework, the list will look arbitrary. It isn't. When economies crash, 3 things happen almost simultaneously. Liquidity vanishes. Trust fractures. Forced selling accelerates. Liquidity vanishes first. Credit tightens. Banks pull back lending. Margin calls cascade. Businesses that relied on rolling debt suddenly cannot refinance. Households that relied on credit lines lose access. Then trust fractures. Investors no longer trust balance sheets. Depositors no longer trust banks. Consumers no longer trust employers. The psychological fabric that holds the financial system together begins to tear. Finally, forced selling accelerates. People don't sell because they want to. They sell because they must, to cover debts, to meet margin calls, to survive. This creates a paradoxical environment. Good assets fall alongside bad ones. Strong companies get sold with weak companies. Valuable property gets liquidated next to overvalued property. The market stops distinguishing quality. That indiscriminate selling is where doubling opportunities are born. Because when fear becomes systemic, price detaches from intrinsic value. In 2008, entire apartment complexes in parts of Florida were sold at discounts exceeding 60%. In 1998, Russia, productive industrial assets traded for pennies on the dollar. In the early 1930s, farmland in parts of the American Midwest fell below the cost of the equipment used to cultivate it. The crash did not destroy the utility of these assets. It destroyed the balance sheets of their owners. That distinction is everything. Now we can begin. Not luxury property. Not speculative development. Not urban trophy buildings. Productive real estate, income-generating property acquired when its previous owner is being liquidated. The Great Depression offers the clearest case study. Between 1929 and 1933, U.S. real estate prices fell approximately 30% to 50% depending on region. But in certain agricultural states, forced foreclosures pushed farmland prices down more than 60%. Farmers who had borrowed heavily during the 1920s expansion were wiped out when crop prices collapsed. Banks seized land, then banks themselves failed. Those with liquidity, often local cash-rich buyers or investors who had avoided leverage, purchased income-producing farmland at fractions of replacement cost. By the early 1940s, as wartime demands surged agricultural output, Those same properties had not only recovered but more than doubled from their depression lows. The key was not timing the peak. It was purchasing during systemic distress when sellers had no negotiating power. The same dynamic played out after the 2008 financial crisis. Between 2008 and 2012, U.S. home prices nationally fell roughly 27%, but in cities like Phoenix, Las Vegas, and Miami, declines exceeded 50%. Institutional investors, Blackstone among them, began purchasing single-family homes in bulk during 2011 and 2012. Not because housing was fashionable, it was toxic at the time. Public sentiment was hostile. Media headlines predicted a lost decade for real estate. But rental demand remained. The asset still produced cash flow. From the 2012 bottom to 2022, U.S. home prices more than doubled nationally. In some distressed markets, gains exceeded 150%. The doubling did not occur because real estate is magical. It occurred because leverage had been purged and forced sellers had reset the price floor far below intrinsic value. Here is the pattern. When crashes wipe out over-leveraged owners, productive property trades below the income it can generate. Buyers with liquidity acquire future cash flow streams at a discount. When stability returns, pricing normalizes. The asset doubles not because the economy is strong, but because it was mispriced during panic. This distinction matters. Speculative assets collapse permanently, productive assets rebound violently, and, during crashes, productive assets are often thrown into the same liquidation pile as everything else. But real estate is only the first category. The second asset that historically doubles during crises is more controversial. It is not land. It is not gold. It is not bonds. It is something most investors avoid during uncertainty. And yet, history shows it repeatedly expands when everything else contracts. If this framework has already shifted how you view crashes, good. That shift is necessary. Because what comes next will challenge a deeply held assumption about risk. The second asset that has repeatedly doubled during economic collapse is ownership in essential businesses, acquired when public markets have marked them down indiscriminately. This sounds obvious until you see how rarely it is executed correctly. During crashes, investors flee equities as a category. Stocks are treated as a single organism. Indexes collapse. Headlines blur nuance. The market becomes synonymous with danger. But markets are not monoliths. They are collections of businesses. And some businesses become more indispensable when conditions deteriorate. The Great Depression again provides clarity. Between 1929 and 1932, the Dow fell nearly 89%. Thousands of companies disappeared entirely, but firms tied to essential consumption, food distribution, basic household goods, discount retail, did not lose customers in proportion to the collapse in asset prices. In fact, some expanded. Procter & Gamble continued selling soap. Consumers might postpone buying a new automobile, but they did not stop washing. Companies with low debt and essential product lines survived the liquidation phase. From the 1932 market bottom to 1937, the Dow more than doubled. Select companies did far more than that. Investors who acquired durable, cash-generating firms at crisis valuations saw extraordinary compounding once panic subsided. Fast forward to 2008. Financial stocks imploded. Investment banks disappeared. Entire segments of the housing complex were erased, but businesses anchored in recurring necessity, grocery chains, discount retailers, utilities, retained demand. Consider Walmart. From the October 2008 panic to early 2011, while the broader economy was crawling out of recession, Walmart shares appreciated significantly as consumers traded down to lower-cost retailers. Revenue did not collapse. It shifted. In crisis environments, spending compresses toward essentials and value. The businesses that serve those compressed categories often see relative strength precisely when speculative sectors implode. This pattern becomes even more dramatic in emerging market collapses. Argentina, 2001. As the peso devalued and sovereign default unfolded, local equity markets were devastated in dollar terms. But companies tied to agricultural exports, grain processors, food exporters benefited from currency weakness. Their revenues, denominated in dollars, expanded relative to local costs. Investors who could identify firms with revenue streams insulated from domestic monetary collapse saw equity positions recover and multiply once stability returned. The principle is structural. During collapse, capital retreats from complexity and luxury toward necessity and simplicity. Businesses that deliver food, energy, repair services, and low-cost staples do not require optimism. They require only ongoing human existence. When panic pricing treats them as if demand will evaporate entirely, the dislocation can be severe, and dislocation is the raw material of doubling, but this requires precision. Not all stocks rebound. Many never return. The difference is leverage and necessity. Companies that enter a crash heavily indebted are vulnerable even if their products are essential. Companies with strong balance sheets and indispensable outputs survive the purge phase and capture market share from weaker competitors. Economic contraction often accelerates industry consolidation. Smaller firms disappear. Larger, well-capitalized firms absorb demand. Ownership in those survivors, purchased when fear has compressed their valuation multiples, has historically produced outsized returns. This is not optimism, it is pattern recognition. When forced selling drives price below the present value of durable cash flow, the correction that follows can be explosive. But there is a third asset class that behaves differently. It does not require a market rebound. It does not depend on stabilization. It often appreciates during the chaos itself, and it is misunderstood precisely because it feels uncomfortable. Cash is mocked during booms. In expansion phases, liquidity is labeled dead money. Inflation erodes it. Opportunity cost punishes it. Holding cash in bull markets feels like watching a train leave the station. But during crashes, liquidity becomes power, not generic. Cash in a failing currency. Strategic liquidity in a currency that retains purchasing power relative to collapsing assets. In 1998, during the Russian financial crisis, the ruble collapsed and government debt defaulted. Domestic savings evaporated. But individuals and firms holding US dollars were able to purchase assets at fractions of previous valuations. Factories, apartments, equipment sold under distress were acquired by those with dollar liquidity. The asset that doubled was not the dollar itself. It was what the dollar could buy at the moment of maximum fear. The same dynamic played out during the Asian financial crisis of 1997. Currencies across Thailand, Indonesia, and South Korea collapsed against the dollar. Asset. Prices in local terms imploded. Foreign investors holding hard currency entered and acquired equity stakes, property, and industrial assets at deep discounts. When currencies stabilized and capital flows returned, those acquisitions multiplied in value. Liquidity during collapse is not passive. It is optionality. It allows acquisition when others are constrained, but this principle extends beyond emerging markets. In 2008, individuals and funds that maintained high cash allocations through the leverage expansion of the mid-2000s were positioned to deploy capital aggressively during the March 2009 bottom. Warren Buffett's deployment of capital into distressed firms during the crisis was not accidental. It was enabled by liquidity maintained before panic. When liquidity vanishes from the system, the price of everything becomes negotiable. Those who are liquid become price setters. This is why, paradoxically, holding cash before a crash often precedes asset doubling after a crash, because the doubling occurs in what you acquire, not what you hold. But there is a nuance here. Liquidity in a collapsing domestic currency does not provide the same advantage as liquidity in a stable external unit. Argentina's peso holders in 2001 were trapped. Dollar holders were mobile. Lebanon's pound holders during the banking freeze were immobilized. Dollar holders operated in a parallel economy. The ability to preserve purchasing power through the initial shock phase determines whether you are forced to sell or positioned to buy. Liquidity is not glamorous. It does not trend on social media. But every historical doubling event during collapse has required someone on the other side of the transaction with capital ready, and capital is only powerful when it survives the shock intact. So far we have examined productive real estate during forced liquidation, essential businesses marked down indiscriminately, strategic liquidity that enables acquisition. The fourth asset is different. It is not purchased during the crash. It is built long before it. And when collapse arrives, it can expand in value faster than any financial instrument. It is not physical. It is relational. And in many historical crises, it has proven more valuable than land or currency. The fourth asset that has repeatedly doubled during economic collapse is concentrated ownership in critical networks. Not social media followers, not superficial connections, not business cards collected at conferences. Functional, trust-based networks that facilitate exchange when institutions fail. When economies operate normally, institutions perform the coordination function. Banks clear payments. Courts enforce contracts. Governments regulate disputes. Supply chains operate predictably. Trust is outsourced, but during collapse, institutional trust fractures. Payment systems freeze, contracts become ambiguous, enforcement becomes inconsistent, and in that vacuum, commerce does not stop. It reroutes. It reroutes through people. Russia, 1998. After the ruble devaluation and sovereign default, the formal banking system became unreliable almost overnight. Businesses could not depend on credit lines or predictable transfers. What kept many companies operational was not policy intervention. It was informal networks of suppliers, customers, and counterparties who extended trade credit based on personal trust. Firms embedded in dense commercial networks survived at far higher rates than isolated operators. The network itself became an appreciating asset. The same pattern surfaced in Argentina's 2001 crisis. When bank accounts were frozen under the corralito, formal liquidity disappeared. But parallel barter networks emerged rapidly. Small business owners who had long-standing relationships with suppliers and customers could transact using goods, services, and informal credit arrangements. The Argentine truque system, at its peak, involved millions. But participants who extracted the most value were those with trusted reputations inside their communities. Their relational capital allowed them to trade at favorable terms while newcomers struggled. Lebanon, after 2019, offers a modern case study. When the banking system effectively collapsed and capital controls trapped deposits, commercial activity did not cease. It reorganized around cash transactions and trusted intermediaries. Businesses that had cultivated multi-currency relationships and strong supplier ties navigated the transition with greater resilience. In contrast, firms that depended entirely on institutional guarantees were stranded. The pattern is consistent. When formal trust collapses, informal trust appreciates, and unlike financial assets, trust compounds. A business owner known for honoring obligations in crisis conditions becomes a preferred counterparty. Suppliers extend better terms. Customers remain loyal. Opportunities surface privately before they reach public markets. This is not sentimentality. It is structural economics. In every monetary breakdown, a parallel economy forms. Participation. In that economy is governed less by contracts and more by credibility. Credibility, when scarce, becomes valuable. Now consider the 2008 financial crisis from this lens. Interbank lending froze because banks did not trust each other's balance sheets. Credit markets seized. But firms with deep, diversified relationships, multiple funding sources, long-term supplier agreements, loyal customer bases were better positioned to navigate liquidity stress. Their network depth functioned as a buffer. Network concentration doubles in value during collapse because it reduces dependency on failing intermediaries. It shortens the distance between production and exchange. And when access becomes scarce, those with access command premium pricing, but this asset cannot be acquired in panic. It must be cultivated during stability, which brings us to the fifth asset. Unlike the others, it does not depend on timing market cycles. It does not require capital. It does not rely on currency strength. And historically, it has expanded in value. Precisely because everything else contracts. In every major collapse, there are professions that implode and professions that expand. The Great Depression destroyed speculative finance, but increased demand for agricultural production efficiency. The 2008 crisis devastated mortgage brokerage, but elevated bankruptcy law and restructuring expertise. Argentina's 2001 collapse crippled corporate finance, but increased demand for mechanics, repair specialists, and small-scale producers. The pattern is simple. When consumers lose purchasing power, they stop replacing and start repairing. When credit evaporates, restructuring specialists become essential. When imports stall, local production gains importance. Scarce skills tied directly to fundamental needs, food, shelter, energy, repair, restructuring, become more valuable when the broader system contracts. Consider Weimar Germany. As hyperinflation destroyed savings, skilled tradespeople who could operate in barter systems retained economic agency. Their services were denominated not in marks but in goods. A blacksmith could trade directly for coal or bread. His pricing power adjusted to real scarcity, not nominal currency. In contrast, salaried bureaucrats paid in fixed marks watched their purchasing power evaporate. The asset that doubled was not merely the trade itself, it was the flexibility of the skill set within multiple exchange systems. Fast forward to Venezuela. As the Bolivar collapsed and formal employment deteriorated, individuals with portable technical skills, mechanics, electricians, informal medical practitioners, operated across both Bolivar and dollar economies. Their income, often dollar-linked, expanded relative to fixed local wages. The value of their human capital increased because it addressed immediate, non-deferrable needs. This is what defines counter-cyclical human capital. It benefits from system stress. Most careers are pro-cyclical. They thrive when growth expands, they contract when growth slows. Counter-cyclical skills do the opposite. They are long volatility, and during collapse, volatility is abundant. But here is the deeper principle that ties all five assets together. Economic crashes do not randomly redistribute wealth. They reprice fragility. Assets dependent on leverage, optimism, and institutional continuity fall hardest. Assets rooted in necessity, liquidity, trust, and scarcity expand relative to the rest of the system. Let's step back and examine the full pattern. Productive real estate doubles because panic pricing disconnects income from valuation. Essential businesses double because fear suppresses multiples while demand persists. Strategic liquidity doubles because it acquires mispriced assets. Trust-based networks double because institutional intermediation fails. Counter-cyclical human capital doubles because necessity cannot be deferred. None of these outcomes require predicting the exact timing of collapse. They require understanding structure. During prosperity, complexity is rewarded. During collapse, simplicity and necessity dominate. During booms, leverage amplifies returns. During crashes, leverage amplifies destruction. During stability, institutional credentials hold value. During instability, direct utility prevails. The investor who survives, and sometimes thrives, through collapse is not the one who forecasts headlines correctly. It is the one positioned in assets that become more scarce when fear spreads. Crashes feel like annihilation because paper wealth contracts rapidly, but historically they have been accelerants of reallocation. Capital does not vanish, it changes hands. The question is not whether the next downturn will arrive. History makes that answer obvious. The question is whether you will be forced to liquidate or positioned to acquire. Because when the economy crashes, 5 assets consistently separate those who endure from those who double. And doubling during collapse is not about aggression, it is about preparation aligned with structural reality. If this reframed how you think about downturns, not as random disasters, but as predictable repricing events, then you are already operating differently than the majority. History rarely whispers. It demonstrates. The pattern has repeated for centuries. The only variable is who is prepared when it does.